and welcome to the final session of the Growthpoint Investor Showcase, saving the best for last. We've got David Green, the CEO of the VNA, who will provide an update on the portfolio, followed by Q&A. Just a quick one from our side before we begin. Just a big thanks to Di and Lauren at Growthpoint for giving us the opportunity to host this event again. And thanks to all the presenters taking the time to provide an update, which has been valuable, at least from our side, on the key operating areas. So just some housekeeping from our side. Please remain on mute and ensure your video is off. And with that, David, you may begin.
Thank you. That's good. So I'm going to give an overview on the trading update. I'm going to talk to overview in all the sectors to start. I'll then go into a bit more detail on the retail, which is probably the biggest, maybe 45–50% of the profitability of the waterfront. More detail on that, and then I'll go into some of the development activities that we've been doing, and I think it's quite a consistent theme. When I came to pull this together, it occurred to me that some things, compared to a year ago, some things are almost exactly the same as they were, but some things are entirely different. So, sort of recapping, the impact of COVID on the waterfront was that overnight we lost a very significant chunk of our business. We lost international tourism. International tourism visitors are maybe 30% of the visitors. But in addition to that, we had a massive drop in office footfall around the precinct, which rolled into both the retail and the hotel sector. There was no business travel, there were no events. So at times over the last 12 months, the waterfront's been a very bleak place. And it's fair to say we've probably lost between 35 and 40% of our visitorship in there. I think what's very different, though, is that while that has not dramatically recovered, we have seen a recovery, a bit of a bump in terms of local. We've done a lot of work to try and attract locals in, so we've done a little bit better there, but no significant international tourists. But what is very, very different is the optimism in terms of the outlook and the recovery. And I'll talk in a bit more detail about what the sort of those indicators are. But anecdotally, you're seeing virtually all the international airlines who had cancelled are now starting in November or December. I'll talk to cruise, but cruise business, there was zero. We have, for the sort of tail end of this season, we've got about 35 visits, but the bookings for next year are over 100. So things are starting to look quick. They're coming back. If I talk to international tourism, the flights, anecdotally, Lufthansa is saying they don't have seats available, prices are spiking. So there's a reasonable degree for optimism. And then coupled with that, the level of inquiry and business confidence has definitely taken a significant uptake from 12 months ago. So while the actual visitor numbers are probably not that different, and the impact on the waterfront in terms of this loss of tourists, low office occupancy is still the same, there's a whole different feeling in terms of optimism and confidence in the outlook. The strategy that we had was to what we called maintain the infrastructure. So by that, what we mean is trying to keep tenants in place, trying to keep the attractions, the markets and everything, small businesses that make the waterfront what it is and the difference, the differentiator that it has. And I think the data shows we've been relatively successful in that sense. So out of the 500 retailers, very little attrition. We're sitting at a void of 3%. Now that's high for us. We would have been running about 1%, but it's still relatively good. The centre is intact. You'll see we've got some new offerings coming up, and there's still pretty good demand on the spaces within retail. But I'll talk a lot more in detail about the retail a bit later. In terms of offices, similar sort of position. Vacancies are low, 3%. we're probably skewed towards P grade, blue chip tenants. All the tenants are honouring their obligations. You know, the big question is, what will the return be? And I think nobody knows that. Every business is different. One day you'll hear stories about offices that will never return, and others that say that they are, you know, the only way they can maintain the culture of the business and the training is to bring back. Predominantly our blue chip corporate tenants are saying that they will substantially bring people back in. So sort of 70–80% will come back in core time. And as I say, we've had nobody indicating they will give back significant quantities of space. But time will tell how quickly the companies feel that they can safely bring people back into the spaces. But corporate office for us has been robust. As you know, we've grown quite significantly in that area, and it's been very, very strong over the period and remains strong. In terms of the hotels and hospitality, they have been very badly hit. Probably 75–80% of the business is leisure tourism, and the remainder would be conferences, would be business travel. But I guess a reflection of the confidence is that all 13 hotels have reopened and are now trading. They are trading very spotty, very spiky. You know, anecdotally, you'll hear some days they are fully occupied, and other days they're running around the kind of 15–20%. But I think there's a general belief we'll have a strong leisure summer season, and I think people are readying themselves for a strong and relatively rapid recovery in international tourism there. In terms of the attractions at the waterfront, pretty much all the attractions, whether that's charter boat activity, helicopter activity, whether it's markets, Two Oceans Aquarium, Zayt's Mocha, they've taken quite a heavy toll in terms of loss of earnings or losses, but they're all open and they're all looking, and they're all already seeing quite significant increases in their visitation. So on to the next slide. So diving a bit deeper into the retail, we've had pretty consistent demand for prime space. We've taken the opportunity to spruce the centre up, so there's quite a lot of refurbishment work going on. What we've seen is good support from locals and tourism. I'll talk to the different sectors and how there's quite a dramatic difference between how some of the sectors have been affected. Overall, very common with other regional centres, lower visitorship, higher spend per head, different sectors performing differently. Our kind of differentiation is, it's always been we were first to the market with the international brands. We've been early adopters of omni-channel and trying to attract some of the online retail so they have the kind of experience, the physical store for experience, and also trying to encourage omni-channel that favours us. So this is the consolidators and having these Checkers 24 or Daily Dash or ASAP being the waterfront being the centre where these items are picked from and distributed. So it keeps our kind of turnover levels up quite high. But next slide. So this slide, the grey is showing the last normal of 2019. This is footfall. The red, go back one. Yeah, the red is where we are now in 2021, and the yellow is 2020. So the two trends you see that, you know, our footfall is still 35–40% down. The second trend that you see is that since July, and that has continued through into October as well, 21 is about 5–10% above 2020. But I think the other trend you're seeing is quite a significant, and we're seeing that continuing upward trend. It is all going to be out for us in retail, the impact of international tourists, how quickly they come back. Next slide. Similar picture in retail sales, very similar picture. 2019, the dark blue being the last normal, the 2021 being the grey, but almost the the sales that are occurring within the retail centre are mirroring the turnover. Next slide. We've always traded at a premium to other super regional. This is IPD data for June. And despite the loss of international tourists, we're still pretty much like on all sectors trading. Our trading densities are above national centres. We're probably though 20 to 30% down in terms of trading densities, and that is the, that overall, that would be the sort of international tourism would fill that gap. Next slide. This is pretty interesting because I think what this attempts to show is just how varied the trade is. So if you take the grocery stores, what you're looking at, the grey is 2021, the light blue is 2020, and the dark blue is 2019. So what you're seeing is that we're trading, the grocers are trading pretty consistently above last normal. So they've recovered and more. Now, I think that suggests to us we've got a little bit of local demographic that we've managed to attract in to the waterfront with just the attraction of the offer. But you are consistently, and it's not far away in the kind of clothing sector as well, that you're trading above, you're at the level. And that has a knock-on effect in terms of the relief that we're talking about. We're only giving relief to areas that have been badly impacted by the tourism. If you move to the right, you look at the restaurants, very, very different picture there. You can see restaurants really badly suffering because of the lack of international tourists, well away from the last normal in 2019. And then bottom left is kind of craft curio market. I mean, overnight they've lost 95% of their business. And yes, there's a slight upward trend, but they're a long way. And then bottom right is luxury. I think you've heard this story consistently from the retailers in South Africa who have luxury sectors in there trading well above last normal. For us, it's a combination. There's local wealthy residents who are frustrated they can't travel, so they spend in this area. We've had a little bit of sort of digital nomads from Africa who've decided to come down to Cape Town to kind of work from home, and they are evidently kind of boosting the sort of luxury spend, particularly amongst the international brands. But it's a very kind of I think what's interesting is just how dramatic the difference in the trading and the fate of the different retailers. So that's what I was going to say. Retail. Yeah, next slide. Just on Marina and Industrial, I've talked quite strongly about office. I've talked about hotel. Marina Industrial, it's the smallest sector we have, probably around 10%. It's been pretty robust, other than cruise liner and charter boat. But fishing industry, essential industries, warehousing, all continue to pay rental. And I think the most significant thing is just how quickly the cruise business the bookings have come in for the coming year. What you can't draw a lot of data from the hotel bookings because people are quite short term. Cruise by nature is a longer term, so it is an indicator, a sort of more long-term indicator of the willingness to recovery. Prior to 2019, we would have had about 50 or 60,000 cruise terminal passengers. We were expecting 250 in the we have given something like significant amounts of relief. Other than following kind of national guidelines when COVID hit, we've pretty much restricted that relief to those tenants who are worst hit by tourism, the loss of international tourism. So it's focused on restaurants, jewellery, hotels, very much tapering off. If you look year on year, year-end 21 to what we expect will be year-end 22, the relief we give will be half or less, all depending, I mean, the December season is coming up, but it will be half or less than we've given before. So tapering off depending on the size of business. In terms of debtor position, we've probably got about a net debtor position in the Waterfront of about 58 million, and of that 35 is deferred income on hotels. We only gave deferred rental for hotels where we had long-term contracts and quite strong surety from them. And those who were due to pay have started paying. And as I say, we've got about 35 million. So we don't see any major problems. As you know, we CNA exited, Edgar's exited, and we've kind of replaced those tenants. So I think we've probably certainly seen the worst of the business, the sort of business rescue, and we're in, I think, quite a strong position. We don't expect any unexpected surprises in the debtor position at the moment. Okay, moving on to development. And some of you might have picked up the announcement. I think it was slightly misleading, but we were awarded planning consent for the Canal District. This allocated 105,000 square meters to the Canal District, and a headline figure was 5.3 billion. Now that is the incremental spend were we to develop out the entire Canal District. Of the 105, we've got about 41,000 to develop, but there's opportunities to enhance the mix. But the immediate developments that we've gone, this is what you're looking at here is Dock Road. As you come in on the top right would be the conference centre coming in. So you have what is now a Volkswagen garage in L. M1 was a Caltex garage. So M1 and N, move on to the next slide, are the developments. So M1 is the 10,000 square metre 5-star green building for Investec. I'm sure you're aware Investec and 91 are splitting, so they can have different cultures, and we are in the ground constructing this 10,000 building. 2,500 will be ours to let, 7,500 will be taken up by Investec. And that is about a 520 million investment, which has an 80 million carry because we're creating the super basement parking for M2, the building next to it. Next slide. Back one. Yeah, we're replacing the Caltex fuel station, putting it at a more appropriate site at the kind of the robot junction at the end of Ebenezer Circle. That's incorporated within the 520 million. Next slide. Waterfront has the busiest heliport in Africa, and clearly it's suffering, but the potential is huge. It's very difficult to get a heliport in an urban environment, and we're looking at the best way to optimize the potential for growth, whether that's connecting with the airport for VIP customers into our hotels, or whether that is kind of luxury flips. The outlook and potential for this is high, and we're looking at how we can expand the capacity in some way on that. Next slide, and the next one. In the interim, our shareholders have been approving kind of infrastructure investments, you know, the thinking being when the hotels are places are quiet, that we should actually spruce the place up and do some of the back of house infrastructure. So we're now going to proceed with this desalination plant. This will take the waterfront off grid in terms of water. So it will initially have a capacity of 3.3 million litres a day, and that will can crank up to 5 million, so we can supply all of the waterfront's development needs from a desalination plant. Obviously, desalination is not the most environmentally friendly, but all of the power will be supplied by alternative energy. So we're already at around 2 megawatts on solar. Once we put the solar on top of the Vic Wharf, we'll be up to close to 3. And we're looking at a waste to energy from the whole precinct where we can generate about another 1.8 megawatts. More than ample to power the desalination and more of our energy. Next slide. It's not a massive project, but it's a pretty significant one. So this is a modular Blackwater treatment plant. It will treat 10% of the entire waterfront's Blackwater sewage. It will be used to provide the non-potable water to the shopping centre and also for the irrigation throughout the whole of the waterfront. Very interesting technology. Rather than these enormously expensive infrastructures that cities are putting in, this kind of modular facility, it should be the way forward. So we're very pleased that we're kind of pioneering one of these plants. Okay, next slide. Yeah, and the next one, yeah, so this is the arrival point of the Venice Hotel, taking advantage of the quieter time at the waterfront to sort of do this kind of infrastructure work. Like the first thing we're responding to is the sort of quite dramatic shift in people visiting using e-hailing and accommodating e-hailing without kind of congesting the whole of the waterfront. So this is to allow an awful lot more stop and go for e-hailing. We've done this at the front of the shopping centre, but it's a kind of factor, and then bringing more greening into the area. Next slide. Adjacent to this is the historic Union Castle building. Again, got a project of about 90 million to refurbish this up, remove the wheel, which is currently in the centre, and we're pretty much let on restaurants and retail to accommodate this. Overall, in restaurants, we have lost out of the 75 eateries, we've lost 10, but we've got 5 replacements, and we're in final stages to replace almost all of them. Next slide. So this is just kind of summarising that infrastructure we're doing around the Union Castle building and the home. And next slide. And one of the restaurants we brought in, a number of you will know Shimmy Beach, which was very popular. To replace that, we've got a new beach club called Cabo Beach, which will feature one of the sort of top international chefs. And in addition to that, another additional hub by December will be a restaurant called Pierre, which is part of the La Colombe group. So I think the closing kind of message is that we've held on to the infrastructure, and that we've got new offering. We're kind of poised to track and hopefully come back quickly and strongly as and when the international tourism comes through, and that's the main kind of factor which will drive. It's not about local market recovery. We don't believe that it's a systemic problem. It's simply how quickly the international tourism and events can come back on stream. And with that, I'm happy to take questions.
Perfect. Thank you so much, David. Just a reminder, if you'd like to ask a question, you can please use the chat function, raise your hand to ask directly. You can email me or WhatsApp. We've got a few questions already. First one from Yusuf. Please remind us, when does the Nedbank lease expire? And when will they likely give back any space as a result of the new work from home policy?
Yeah, so the Nedbank lease is October 31, so we got a long way to go on that one. So the second part of the question was?
Given that they've have a new work from home policy. So I guess the sense is that, you know, the requirements for office space is reduced materially compared to what it was pre-COVID.
Yeah, look, I think there is going to be shakeout. I think it is probably just too early to say where that's going to be. I think we've been fortunate. We've had a combination of local demand, but we've also, I think the Waterfront is, if there is international demand coming in, so we've still got a steady stream of interest in it. I mean, we're protected till 31 with Nedbank, which we're pleased about, but we still do see a combination of co-working. We're quite early into the co-working, and blue chip head office being a demand.
Do you have line of sight with regards to summer bookings for the hospitality assets? You mentioned in the presentation that some of it is a bit short term, but can you provide maybe an update? You know, if there's been.
Yeah, I'd love to, but I think what is, you know, there's still a lot of hesitancy. Traveling has been an unpleasant and stressful experience. You know, the multitude of kind of vaccination, testing, quarantine. And as such, what all you can do is kind of draw from international experience, and you know, people have they can respond quickly, but they're quite short term. I think there's a hesitancy because of this stressful nature of it. We are fortunate in this country in that we've always kept our borders open, and we're pretty clear about what is required, and that is a PCR test. But other countries, it's all about when they return to their own country, whether they have to quarantine, what regulations they need. So I can't give you that, and actually I would argue that, you know, while you've got things like forward keys and forward bookings, you can't place a lot of relevance on that, because what's happened is that bookings that have been in, people are not booking long term in advance. Those bookings that have been there for a long time quite often are sort of cancelled. I think literally the next 3 months are going to be pretty telling. These are peak season. The airlift is currently around, internationally is about 35% of historic levels, but it is building up to 50%. And I think it's going to be very interesting to just track what level of tourists do come in here. Unfortunately, I can't give you visibility on it. It's going to be one of these wait and see for the next 3 months to see what level comes back in.
This question came about when you were chatting about the attrition within retail, and you gave the information already, but just to remind, was there any churn in the restaurant exposure, and how much did this represent as a proportion of income pre-COVID?
Yeah, so we're heavily in retail. We're sort of almost 25% food and bev, if you put it that way, and we'd have sort of 75 or 80. As I say, we lost 10 for various different reasons, and we've got 5 of them are replaced, and they're good replacements. Things like Cabo Beach, La Colombe, Sari is a Muslim-friendly restaurant that we've got. There's still demand. Unfortunately, there's been a little bit of hesitancy, so we're not going to have filled all the vacancies, but by season. But we're negotiating virtually all the spaces. It will again depend on how quick that international tourism comes back, and in what form that it comes back. Our international tourism is first and foremost leisure driven. Then there is an element of eventing, and I think eventing will take a little bit more time. Although, you know, we've got Energy Africa conference in the Waterfront now, and you know, you're starting to see some sort of normality. I think international events will take a bit longer to come. And then, you know, what's going to happen in terms of business travel? People are saying one extreme says you don't need to business travel because of Teams and Zoom, and others just saying, well, Teams and Zoom is just another SMS or a WhatsApp or email. It's just another channel, and the need to get together and meet is as strong. And business travel, you look at domestic flights, and they're recovering to almost pre-COVID levels. There's an argument to say that business travel will get back up to normal kind of levels. But we've had that attrition. If we were to pull 5% back from restaurants, it would be a lot. Is my view.
And then we've got two questions. One I received directly via email, and Yusuf, but they're both interlinked. Maybe can you give us a sense of the capex cost around the desalination, the Blackwater plant, and the third part is the renewable energy source already in place, or does that need to be built as well as part of that sourcing of energy?
Yeah, so the desal plant is a 182 million investment. The Blackwater treatment is small. It's just 12.5 million is the investment in that. The bulk of the alternative energy, which is the 2 megawatt, is already installed. We've got about another 700.7 megawatt to come on the Vic Wharf. That would be an additional expenditure to come. And the waste to energy plant is still not landed the full figure on that one. That would be an additional investment in waste energy, but very strong payback on that. I mean, that one, if you take the whole Waterfront precinct, you take kind of fish, from organic fish waste through hotel waste, restaurant waste, we've got a pretty strong case to collect that waste and put it through this pyrolysis machine and generate energy there. So I'm in my mind, it's around the kind of 50 million investment, but it's got a strong payback.
And then just moving on, a question from Paolo. Negative reversions of minus 5.2% was the first negative for VNA. Do you anticipate this to be a new trend in which rentals need to rebase, or do you think this is largely a one-off?
Yeah, it's a very good question. I think the Waterfront's trading densities are driven by local market, but international tourism and events and office. I would say that we are currently, we're holding the line. So our reversions are between the 5 and 10, negative reversions are between the 5 and 10%. The tenant, we're holding the line, we've got low vacancies. People have an optimism that these previously very high trading densities will return with the international tourists. If the international tourists were not to return, then there would be an argument for rebasing. But at this point, the low vacancies, the demand that we're seeing, there's a confidence that the international tourism will return, the events, business travel will return, and therefore there's not going to be a need to rebase. I think when you're looking at other super regional shopping centres, you're looking at a dependency on the national economy, and you're looking at a consistent kind of decline or pressure from that. You're escalating at whatever you are, 7.5, and you've got a national growth of 1%. The tourism was driving growth of between 7 and 10%. So escalations in the kind of 7% were quite acceptable, and therefore there wasn't a need to go to material negative reversions. There are obviously exceptions, but simple answer to your question is right now there's a belief that the tourism could recover, and there will not be a need for this sort of restatement to take place. And that's the experience we're having in our rent renewals and reversions.
Another question from Paolo. Could you give us an indication of how Workshop 17 is performing, current utilization rates?
Yeah, I mean, Workshop 17 is full and is almost above capacity. You know, it is kind of from a remote working co-working space. It is, you know, almost you could say co-working's time has come. If we look at all the co-working spaces we have, they're all actually benefiting. So they're trading well, albeit that one element of income is events, and the events have not recovered to the level, so they've not got that level of trading. And the other, of course, is that they have the density, the numbers of people they can fit in the space is less. So although they're trading above, they're probably trading below their capacity. But I think we're quite bullish about the popularity of co-working spaces, particularly within a kind of waterfront environment, because of the amenity value of the collective offering in the waterfront.
Got a question from Nessie. Vacancies don't seem to be a problem at the VNA, given that it stayed low through COVID. Rentals also seem to have stabilized across the portfolio. With the rental normalization in hospitality and other retail, can we start thinking about revaluation of VNA portfolio in the second half of next year?
That would be a wonderful thing. I need to caveat that the hotels are taking a lot of pain. It is potential, but you know, some of the hotels are trading at 20% occupancy, and they've got discount on their rate. So there's like quite a long way to go there. Our trading densities in the retail, in those sectors, restaurants, jewelries, curios, where we're pretty strong, are taking a lot of pain. And as I've said, the sales levels that they're currently achieving are sort of 35% down, and that's what I said when I introduced the talk. In many ways, we're in the same position we were a year ago. The difference is that there's optimism and business confidence. I think 6 months is too optimistic to get back to normal levels. Having said that, summer of 22-23, providing no factor X comes along, is probably a realistic possibility, and then you might be looking at some form of some sort of valuation. We have reduced value, but probably lower than the overall sector. I think we're overall about a 10% reduction in value. Because the driving factor is not a systemic thing, it's something that can recover, there is a prospect of it coming back.
And just maybe a follow-up from my side, and could lead into the next question that was asked, is you mentioned hospitality is currently running at a 20% occupancy. What is the requirement for break even at normal rates?
Yeah, I mean, I think most hotels, it varies, but they would be talking about a 40% occupancy. Would be your kind of rule of thumb.
And then, I think the next question was, the recovery on hospitality asset deferrals. What is the term of that? Is it a 12-month requirement to pay, or is it kind of will you start billing as profitability improves?
Look, most of them will have some sort of turnover kicker, but I think it's a 24-month period. Most of them are quite long leases, particularly in the hotel sector. So I think they're, if memory serves me, it's about a 24-month deferment. But we would look to, if they could, we would look to accelerate that. But the total is 35 million that we've got outstanding on it, which we don't believe is at risk. As I say, about a 24-month recovery period.
And then sticking with hotels, from Paolo, did any of the hotels have pandemic insurance?
Not to my knowledge. Not to my knowledge. It's not been brought to our attention. that they had. You know, we've 12 hotels here. They're all on different arrangements. You know, the extreme is in this case is Radisson Red, where we have a management contract, so we're subject to the operational risk. Other end of the extreme are pretty low ground rents like City Lodge that we have. The big ones where we've got a strong financial involvement would be Table Bay, Newmark Hotels, and the sort of legacy group hotels are the sort of bigger ones. And I'm not aware that they did have cover for that.
And then just a final question from my side. I know Yusuf asked the question on the Nedbank lease, but are there any major office leases coming up for renewal over the next 12 to 24 months?
Not over the next 12 to 24 months, no.
Perfect. So if there aren't any more questions from the participants, and I'm pretty comfortable on my side, I'd just like to thank everybody for joining in. Any concluding remarks from your side, David, before we close the meeting off?
No, just thanks for the interest and the insightful questions. Appreciate it, and thanks for
brilliant. And thanks again to all the participants over the last 2 days for dialing in, and to all those who've presented. Again, a big thanks to Growthpoint for allowing us to host this event. Thank you very much, and this is closing the Growthpoint Investor Showcase. Good day all.
Thanks very much.